Hello everyone, good evening. I hope everyone is safe and doing good. I Yash Dugar, founder of Crealth Research and Educare. I welcome you all to today's enriching webinar. I hope everyone is again staying safe and doing good. So before I start, is my voice audible to everyone? Just a quick yes on the chat box so that I'm sure that my voice is audible. Okay, perfect. So great. So once again, welcome you all to today's webinar. As we start every webinar through a life learning, which I give every webinar. So today's life learning is believe in yourself when no one does, have confidence on yourself when no one does, and pat your back when no one does. So the main message behind this is for everyone is that there will be stages in your life when maybe no one believes you, no one has confidence in you. Maybe you will be low at that time, but that is the time you have to encourage yourself, and that is the time you have to tell yourself that you are the only person who can change your life, and who can bring your life in a better way, and who can prove others wrong. Because a lot of time people may not believe on you, may think that no, you are not able to, you will not be able to do it, or maybe you'll not be able to achieve it, or you are not capable enough to achieve it. But there's nothing which is unachievable in our life, in the markets. People have made it done, people have followed discipline, people have followed the rules, and they have made it. And trust me everyone, like before I'll just give you my example only. The day I was starting this webinar series, a lot of people told me that on a Sunday night, who will come and watch your webinar? You should not do it on a Sunday night. I don't think so people will watch. At the same time, when we started our YouTube channel, the same thing people told us that no, people won't be interested in there's already a lot of content available. But with the good wishes of you all, with the love, with the blessings, we have been getting great response for our webinars. Today also more than like 100 people over Facebook and Zoom have joined us on a Sunday night. So it itself shows your love and affection for our webinar. So thank you so much. So before we start, we'll all take a pledge as we do it. So I'll speak that you all will believe in yourself and have confidence on yourself, because you are the only person who can achieve success for you. So write I pledge in the chat box if you believe in this, and don't disbelieve yourself. Don't never ever think that you are not capable enough, because there's nothing which anyone cannot achieve. God has given everything to us, everything same to all of us, so we all can achieve this. Okay. So now let's start our webinar. So before starting, I would like to introduce the speaker and welcome him. So today's speaker is Mr. Prasham Shah. Prasham Bhaiya, are you there? I'll just unmute you. Yes, you can unmute yourself now, and you can start speaking.
Hi everyone. Hi Yash, how are you?
Yeah, I'm doing really good. How are you?
I'm good.
So
I'm good.
Before we start, I'll give a quick introduction of what Prasham Bhaiya does, and what he has achieved till now. So Prasham Shah, he heads the institutional desk for a very reputed firm in Mumbai. He has done his Masters of Finance through Jamnalal Bajaj, which is a very reputed college. And he has always been a passionate investor, passionate towards equities. He has been tracking equities. He has been trading and investing in equities from his college days, and is always affection and on always. What he tries is to share knowledge with people, make people educated, and that is why he has come today for sharing some great insights on a very, very interesting topic, that is behavioral finance, and how does it affect your investing and trading decisions. So it is going to be some great learning today. There will be some great data as well as insights which will be shared by Mr. Prasham, and of course we'll be learning a lot of new things today. So do stay till the last so that you get to learn a lot of things. So Prasham Bhaiya, once again welcome, and as we start every webinar, I'll request you to please share your journey from the beginning, like how did you start your college days, and then Jamnalal Bajaj, and then you're working for a great institutional firm. So just get us through that journey in a very candid way, so that people also get motivated, and the people who are young people who are watching us can achieve what you have achieved till now, and the passion towards equities which you have. Please share this with us.
Thank you so much for your kind words, Yash. I think you have been kinder to me than I think I deserve. But I think a lot of what happens is very much in hindsight that, you can look back and say that, X, Y, Z happened and it fell in place. But yeah, one thing was definitely there, that the passion for equities was always there with me. And ever since college days, I think, and I think I started when I started with equities, I started with the 2008 downfall. So I think that was a very good learning. When everyone was making money in markets, I started with losing money. So I think that's the tuition fee that you have to pay to the markets. And
Absolutely.
thankfully, I could afford it then, because the corpus was not much. So that itself was a great thing. I mean, and yeah, over a period of time, I mean, you see and you learn, and I think it's still very much work in progress. I mean, we're all still learners and students of markets. I mean, it's not that you've achieved and sort of you arrived or anything. It's just that you keep working at it and keep your vision and goal. I mean, and leave the rest to destiny. I mean, whatever is in your hands, you try and do the best of that. And yeah, and yeah, the other thing was that the advantage was that I recognized where my strengths were early on. And I like public speaking, connecting with people, all of that. So that plus like equities का जो कीड़ा था, that so that made me, and it didn't happen in one shot. It happened after a lot of pivoting and all of that, to finally come and do something that you know like. And I think that's one of the best parts of life, right? Getting to work in something that you like doing. So yeah, that was my story. But having said that, I think I should more than that start with this. So behavioral finance, the topic which is there, right? That is
Before we start with the
yeah.
topic, gradually I have more
uh,
questions for you. So
sure,
we'll
sure.
take two or three or more questions, and then of course I know the whole audience is waiting for your presentation and how behavioral finance. And in fact, I've seen little bit part of it, and let me tell you, people, it is a great presentation which will be shared by Prasham here today. It has some great insights, let me tell you, and you'll be shocked after the presentation is over. So, before we start, definitely I'd like to ask you two, three questions, which is very, very important. That is, what were your failures during your days when you were there in college, or maybe when you were in your MBA days, which you failed in the equity markets? Maybe you face something now, and you like to share, because a lot of people share their success stories, but I always ask the speakers to share some of the failure stories, so that people get to learn from that, and when they face these kind of failures, they do not get themselves down. And maybe how did you encourage yourself to come out of that? So something if on that lines.
So I think, yeah, the biggest failure story was the crash of 2008, right? Every day that you see everybody else making money, and then you enter the markets and you just see the markets fall one way. But I think at that time it's important to, I mean, I always kind of looked back and thought that there are always people who are making money. Maybe I'm not in one of them, but there are people, success stories of people who are successful. So if they are doing something and I am also trying to do the same thing and I'm not making money, then the fault is probably on what I am doing, because it's not the system. Because if somebody or the other is always is successful, then you probably have to look inwards. And I think that is one of the things that I was very early on I did, and I keep doing that. I think it's very easy to point flaws to others, like this that went wrong, but ideally to be objective and try and look inwards is where people generally digress, because self improvement is best spoken about than actually implemented. So I think that's one thing that I tried to do and I still try to do. And the other is, of course, a lot of it gets covered in the presentation. So a lot of the biases that everybody falls prey to, I was also one of them, and you continue to be prey, because that's how the human mind thinks. So I think, yeah, one of the things that whenever things go wrong or look, go don't go according to plan, ideally you should look at somebody you look up to and see how that person has done it, and don't lose heart and don't lose faith in the system, because that's the easiest thing to do. Or to give up is obviously the easiest thing to do. The more difficult thing is, like I said, look inward and see what the other person who's successful is doing that you're not doing. I mean, and generally it's a very basic thing. It's not rocket science actually. It's more basic than we care to admit. That is what I have learned actually.
Absolutely, absolutely. So some great sharing by Prasham. So of course we have to learn through a process, and of course it's a learning process which goes on, and these are the failures which are actually the pillars to success, which point you to the path of success. So so one more question, which before we start, because I don't want people to wait, and even I'm also eagerly waiting to see the full presentation. So how was your life at Jamnalal Bajaj compared to the life which you have right now? Because working for an institutional firm requires a lot of more kind of time, more kind of effort, and of course, MBA colleges. A lot of people watching us would be aspiring to go to MBA college and then getting a good job, and like working like you, who's working for his passion, which is the most important thing, which I believe. So could you guide them? And plus, how is the difference in life working for an institutional firm where you have to constantly talk to fund managers, constantly get good ideas for them to buy and sell. So just get us through that journey as well.
Yeah, so I think college was a lot easier in the sense that your sole ambition was to get a good job, and you're always well protected because at the end of the day, whatever happens, you have your college backing you. And but one of the things that I learned during college was we had one of our teachers, Mr. Professor Mankikar. He is a great investor. So I learned a lot from him when he used to speak about markets, and he used to say that I don't do very great things in a year. I have probably 5 ideas that I invest in, and two are multi-bagger successes, two are failures, and one does just about enough, just sort of breaks even. But in that, on an overall portfolio basis, I am very happy. So his actually clarity of thought and clarity of vision, the way he used to look at managements of companies, all of that, that was really interesting, and he was very blatant and brutally honest about it. Like so I mean, he spoke about a company and he said that what a fantastic company, but what a lousy promoter. He buys a yacht and he buys the yacht with my money. So I mean, I want the company, but I don't want the promoter. And people who follow it, of course, know that he did wonders with that stock and that company. And so that clarity of vision that he had early on it was great learning. But yeah, the real world is a lot more different because it's far more practical, less bookish, and you're on your toes. I mean, but yeah, one thing is definitely there, that you should have conviction and believe in what you're talking or what you're pitching. As long as if you have that conviction, it comes across. And always don't look at a shortcut way that if I do this then ye ho jayega, because in the longer run it just comes and haunts you. If you're convinced about something and you're basically willing to go the extra mile pushing that idea because you're convinced, then that kind of is always good. And I think building lasting relationships, that's something which I think is something which even college teaches you, and even actually the real world teaches you, that effectively it is be it capital markets or any other business, it's all about building lasting relationships. So everything else is secondary, but when you can build, and that's what I've tried to do even with my clients, with my fund managers, making a kind of a honest and a sustainable longer term relationship, because you can go wrong in an idea, you can believe in something and it could not work. But the question should never be that of your intent. I mean, nobody is 100% right all the time. I mean, and one of the things is that you don't have to be precisely right as long as you're not exactly wrong. And that kind of margin of error capital markets gives you, and even life gives you. But it's just that you have to be very it should not be something of a error of intent, is what I think is there. And yeah, honestly, own up to your mistakes. If things go bad, then instead of rubbing it under the carpet, you say, yeah, this didn't work, but I still think that this will work and this will not work. I mean, I think being honest and upfront is something that everybody appreciates. And yeah, I think that's about it. Yeah.
Great. So I think some great insights by Prasham already, where he told that, of course, the journey of college days is quite different to what he's doing right now. selling ideas to fund managers. Of course, that's a tedious job, but if you are passionate about it, if you're passionate about equities, this won't be a tough job for you. And of course, I think he is loving his job. And as he told that, of course, you cannot be right all the time, but if you're right, you have to make it good. And if you're wrong, you have to exit early. That is the mantra which we all follow and we should follow for making our investment success. Okay, so now the time is up where we should definitely go with the topic of today, that is how behavioral finance affects your investing and trading decisions. So the floor is all yours, Prasham Shah. You can start with your presentation, because even I'm also very excited, and I hope all the audience is very excited to see your presentation, to learn actually what behavioral finance, because a lot of people don't know what is it all about and why behavior is important for an investing. Because when I shared this topic with a lot of people asked me that why behavior is important. So I told you, come and see what why behavior is important. So all yours.
Yeah, thanks so much. So I'll start. Actually, I'll just start with one clarification and disclaimer that the topic is actually simpler than it sounds. It's and like most things in finance, it's more complicated. It's made out to be more complicated than it really is. So essentially, behavioral finance is a very simple thing on how you look at money and how you look at your own way of looking at money and in investing and in finance. So the most important thing is that human beings, we believe that we are very rational when it comes to decisions with regards to money, and that can be any decision. But we always believe that we are absolutely rational, and that is not the case. Actually, we are far more emotional when it comes to money making decisions than we think otherwise. And so this stream of behavioral finance is a more recent one. And there are these this economist Richard Thaler who's developed this theory. So essentially, I'll just start off with the topic and the presentation. So there's a saying in markets, right, that investing is simple, but it's not easy. And this is by none other than Warren Buffett, somebody that everyone looks up to, right? So what this essentially means is that, it is simple. Why? Because you have to buy low and sell high, right? That's not rocket science. Everybody knows that. But it's not easy because it requires objectivity, discipline, and willpower. Now, in this, a lot of us always tend to confuse objectivity with having and discipline and willpower with having a lot of IQ, a lot of knowledge. But the softer aspects of investing are far, far more important, which is discipline and willpower, which is actually the emotional quotient part of investing and not the intelligence quotient. So IQ versus EQ is always a debate that people have. And none other than Warren Buffett has said that if you have an IQ of over 130, please sell 30 points and then please sell the remaining and come to the market. So that what it means is that too much intelligence won't get you anywhere. I mean, intelligence threshold is important, but at the same time, being emotionally having a high emotional quotient is equally important. So that's essentially the essence of it. Simple, and it's not easy, because every single day that you see stock prices move, you see markets move, you can be bogged by various biases that come to your mind. So this is what essentially it is, right? Success in investing is two factors. One is skill and the other is temperament. Now, skill essentially is how much of the quantitative or the quantitative aspects you know. So it could be like financials, business models, or skills in terms of technicals, analysis, all of that. And the other is temperament, which is actually the behavioral aspect, like we spoke about, discipline, willpower, and objectivity. Now, most of us in any field that we go, right? Even so, this what I'm saying is not only applicable to investing, but most of money decisions. We feel that skill is the most important thing. So, I mean, if I was to ask any of you, you all can reply in the chat box. What percent do you think is the role of skill, and what percent do you think is the role of temperament? Just like ballpark numbers, if you could give, and if you can just say what percent do you
Giving
think
down
is
the answers for you:
yeah,
30, 50, 50, 40, 60, 10, 90, 70, 30,
okay.
60, 40.
So
So I
it's
think,
fairly divided, right? The opinion is
yeah,
fairly
fairly
divided.
divided.
But ideally, so what people tend to do is spend 80% of their time in building the skill and 20% of their time in temperament. Whereas, the exact reverse is what is important for markets. which is actually 20 to 25% skill and 70 to 80% temperament. Now, why I say that skill is lesser of an importance, because today's day and age, information is freely available, right? If you were to just Google, so much of information, so many stock ideas, so much is available, that the skill aspect, reading and applying that is, I mean, most people here will also, have a view on, what stocks, what sectors to buy. But why the temperament aspect is far more important is because when you've made that decision, to stick to it, or to be objective enough to, exit it when you've made a mistake, is where people are not, and you don't, and we consciously don't even work towards the temperament aspect. So that is where the issue is, the entire focus goes on skill, whereas temperament is a byproduct that one feels. And what happens and what ends up happening is that, you make suboptimal decisions and you still continue to work on skill, whereas the problem is somewhere else. So that's temperament. In fact, there's a very interesting story I keep telling, so I think most of y'all would have seen MS Dhoni, the movie, right? I mean, most people would have seen that movie. So in that, there is this one aspect where, Dhoni is leaving so he's playing for Jharkhand and Bihar, and there's a big hype about Yuvraj Singh from Punjab. Okay, he's a great player, and this very fancy rich kid who's there and is great at playing. So, and Dhoni and his friends are from, a humble background, like everyone knows, right? So they cross each other on the basketball court just before the match, and the fact that all his teammates are so overpowered and awed by, Yuvraj's persona, and that kind of shows in their temperament on the field. And then later on, Dhoni, in much later in the movie, if you've seen it, you'll know that he says that, आप पता है मैच कहाँ हारे थे? हम मैच फील्ड पे नहीं हारे थे, हम मैच वो बास्केटबॉल कोर्ट पे हारे थे. And I mean, so you have that, right? That's the temperament, and both are legends. I mean, I have great respect for both of them, but that's actually the role of temperament. That is, skill wise, I mean, everybody was there, right? Dhoni and his team was also as skilled, but it's the temperament which kind of made or break thing. And that again is, in most things in life, it's the temperament aspect which kind of is what makes or breaks it. But anyway, coming to the topic today, so bias, in a simple sense, bias is nothing but a preconceived notion that you have about something. It could be about anything, right? And in the today's talk, it's more to do with like stock market. So I'm just a couple of examples of, say stock market is a gambling place. So a preconceived notion which may or may not be backed by, facts. It could be backed by somebody else's opinion, somebody else's experience, all of that, right? So these are examples of biases. I mean, I'm not saying it's right or wrong, but these are just examples. It's like the stock market is a gambling place. Now, if you come with the mentality that it's a gambling place, then everything that you will do, it will reflect that, you feel it is a gambling place. When you do well, you will, and human beings always have this tendency that, if something goes right, then it is their genius. But if something goes wrong, then it is everybody else's fault, right? Like it's always like that. It's never like, if you do well, you get a stock idea, you do well, you always end up praising yourself more than, if something goes wrong. When something goes wrong, then you have 100 people to blame, that, this person told me, मैंने यहाँ पढ़ा था, वहाँ पढ़ा था. It's always, and when it goes right, it's mostly always your own genius actually, at play. So that's and again an example of a bias, right? In simple terms, bias is just basically, a preconceived notion on anything that you have. This is again a very, very interesting picture. So there's an example of a rhinoceros who's painting, all right, and whatever it paints, it draws the horn in the middle, and for the rhinoceros, that's the reality. That everything has a horn in the middle, whereas that's not how it is, right? So what the picture says is essentially that we don't see the world as it is, we see the world as we are. So that is the basics of how objective human beings are, right? Like this is the most stark example of that. For this person, for the rhinoceros who's painting, everything has a horn in the middle, but it's not how it is, right? It is from that person's viewpoint that it looks the way it does. So this is something which is an extremely powerful picture. I always loved it because, it just shows that, no matter how objective or how, you are, you always view the world from your own lens, and you're colored from your own, experiences of the world. So I just thought I'd put this here. And so, yeah, I'll just do this quick questions. You can, just tell me the answers. And the idea is to do this fast, okay? I mean, just give me very quick answers to this, very, very quickly, okay?
I'll coordinate this,
yeah. Yeah, you coordinate this and let me know the answers, I mean, just one or two is fine, right? And everyone can just try it, I mean, So if you have 5 machines which build 5 widgets in 5 hours, how long do you think 100 machines will take to build 100 widgets? All right, you can just start typing your answers on the chat box. All right. Uh, uh, okay. The second one is, just be very quick with this. If a bat and a ball together cost
You can
110
give your
rupees.
answers on the chat box. Yeah.
Yeah. If a bat and a ball cost 110 and a bat costs 100 more than the ball, then how much does the ball cost?
Okay. So we are getting a lot of answers.
All right.
5, 10, 5, 10.
And the last one. So a bacteria in a dish doubles itself in 1 hour. If it takes 16 hours to fill up the dish, in how many hours does it cover half the dish?
So again, a lot of similar answers I'm getting both on Facebook as well as Zoom.
All right. Okay. So the answer to, if 5 machines make 5 widgets in 5 hours, so 100 machines will make 100 widgets in again 5 hours, right? Because if you're increasing the number of machines and the number of items to make, it'll still take 5 hours. But most answers would have probably been around 100. I mean, you can tell me. I'm not able to see the chat here, but
Yes, there some of them answered it correctly, but most of them answered
that's
it.
great. That's
Yeah.
great. So if this the ball would cost 5 rupees, but I mean most would have a tendency of answering this as 10.
Yeah, most of them answered 10.
And this one is 15, and most would have answered 8.
Yeah, true.
And the ones who didn't, that you can go to them for investment advice.
True.
And yeah. So in this survey, when it was done with a lot of people, 17% participants answered this correctly, right? And under pressure, when you have to make these decisions, right, it's about how you think logically versus how you think emotionally, right? And this is essentially that. Under pressure, intuitively, you will have the answers that I told you, like your answer will be 100 widgets, your answer will be 10 rupees, and your answer will be 8 hours. But so emotional decisions are based on what you're familiar with and how intuitive you are, whereas logical is something which is not. So the point here is that the emotional decisions come more easily to the brain, especially under pressure situations, especially when people are asking and there's less time. It's the emotional part. Emotional brain is which is very, very easily activated rather than the logical one. And this is true for everybody. I mean, only 17% answered correctly over a wide number of surveys, right? So that just goes to show that we tend to use our emotional system far more in decision making than we admit. And this is true for everything. Every decision we may think that we are being logical, but at somewhere down the line we are colored by a past experience or past something that we make it a emotional choice rather than a logical one. And this, I try to give this example because there's no point telling us that we do this. When you actually experience this and you do this, you'll see that under pressure you always end up making the decision which is most intuitive to you, and that might not necessarily be right, actually. So let me come to the most common bias of all time, and especially in this kind of a market when every day it's rising and it's scaring everybody very away from the economic reality. So the biggest bias that people suffer from is overconfidence. And this happens in bull markets, and the exact opposite happens in bear markets. That when markets are down, everybody suffers from underconfidence. When you've seen your portfolio being hammered 20-30%, then everybody is underconfident. And when you see, without much of your effort, you see the portfolio going 10-20% up every single day, you feel that it is your genius that is causing it. So there's a very interesting bit that US students were asked
Yeah,
to
this is very true. The
judge.
statement.
Sorry.
This is very true. That like the statement
Yeah,
which you
yeah,
told, the
yeah,
underconfidence and the whole. I think everyone would
yeah.
agree with it.
Yeah, and this I'm taking examples from real world, because the real world examples are far more relevant, because what is true there is true even in markets, because the market is nothing but a collective decision of thousands and lakhs of people, right? So in fact there's a very interesting story that there are 6 blind men, and they are taken to a elephant, and each is asked to they are blindfolded, and each is asked to look at a particular part. One is made to feel the tusk, one is made to feel the leg, one is made to feel the trunk, and each is asked to say what they feel about it. So everybody has their own different perspective, and a market is collection of so many such individuals. So what a person feels, so that is where the emotional aspect comes. It's basically where you come from is how you will end up thinking. So this is just that a sample of US students was asked to judge their own driving safety. 82% said that they are in the top 30%. So most people thought that they're in the top 30%. If you ask business owners, so 81% of new business owners thought that their business had a 70% higher chance of succeeding. But when you ask them about the industry they are in, they thought only 40% of that industry business is likely to succeed. So 80% think that they will do well, but actually if you ask them in this industry, they thought that exactly half of them will do well. And the last one is amazing. If you ask students in a class, 80% students believe they'll finish in the top 50% of the class. So that just goes to show how people overestimate their own abilities and underestimate everybody else's abilities. So that's also true for markets, right? That statistically, when you look at traders, that 1 to 5% of traders make money in the markets. But when you end up entering the market, you always think that you'll be in the top 1%. Or when you look at investing, you will always think, but I am different from everybody else. And that's a very human thing. There's nothing wrong. The idea here is actually not to, it's not that if you don't know this, but if you can acknowledge that this happens, you can probably step back when it actually happens. So that's really just the point, of this. And what happens with this is essentially, you make bad bets, you trade more frequently. And again, like I was saying, that you step back and you analyze the source of your conviction. Is it fact based, or it's just skewed out of some confidence that you heard somebody say, or you read it somewhere, or all of that. And the idea is essentially that you don't have to be exactly right as long as you're not exactly wrong. So that's the point, right? You don't have to be precisely wrong, right? You may say stock will appreciate 20%, so you don't have to be exactly 20%. As long as the price is not appreciating depreciating 10%, you're okay. So that's just what happens with overconfidence and that bias. The second one is confirmatory bias. This is again, I mean, one of the most frequently encountered one, right? So if you look at your friends and people, you will always look at people who agree with what you say rather than people who disagree with what you say. This is a human tendency, right? That you have a tendency to reject anything which is contradictory to your view. If you made a view on Reliance that, for the next 5 years, I think Reliance is a bull story. Anybody who tells you otherwise, you will not want to listen to that, and you will. And what happens in this case is that, you are looking at, you already made up your mind, and you are looking at ways and means that, people tell you the same thing. In fact, how this bias actually plays out is that, if you've made up your mind on a particular thing, you will not even ask a person who you think will say something otherwise. You will always end up asking a person who you think will agree with your hypothesis. And that could happen subconsciously also, You ask somebody, you ask this person, you'll be like, "Arey, this person is mandi mein hi rehta hai hamesha, usko kya puchna?" And this happens everywhere, If you've decided that you want to do something, you will only ask people who you think will agree to that. And that's a very human thing that, once you've made up your mind, you will reject any contrary information to your hypothesis, And what successful investors do is, they actually, if you listen to what Buffett and all of these people do, is they actually have somebody who will criticize each and every point of theirs and will point out the mistakes in their, decision making, rather than, be yes, it's all correct, And, when they're able to, objectively assess that's when you're able to, do that, and that this is a very, very stark kind of a bias that everybody faces in most things. And the beauty is that, you subconsciously do this and you don't even realize that, you're doing this, So this is obviously one of the most big hindrance in, successful investing. And most successful investors actually look at opposing views, not supporting ones, but, actually look at, what is it that can go wrong? You ask somebody, bhai, what is the worst case situation that can actually go wrong? So you don't essentially shy away from changing views, in light of new evidence. So this is one very, very important bias which plays across in all spheres of life, not just markets. I mean, I'm just using markets as an example here, but everywhere. And then, of course, recency bias. This, though, who knows better than when it's a bull market, right? Whenever there's a bull market, you cannot imagine that,
True.
there can be a bear market. You cannot imagine that, so there's a saying, right, that, all missed opportunities are in hindsight, because you look at that price and you go like, wow, that actually happened. And when that happens, you can't imagine that, this can ever go up, and the same like that, when the markets are up, you cannot imagine, right, that the markets go down. But what does the trend tell you historically? That what goes up must come down, right? So in the bits of 2008, I did have this kind of insight, but I mean, I was obviously, nothing's ever going to look better. But had I invested very heavily then probably, I would, I mean, then, I would have been much happier at this point of time. So I'll just give you a couple of examples, right, that highlight this. Imagine you've eaten a very hard meal, okay, a very, very heavy meal. Uh, Anyone who puts food in front of you after that, right, you will be, you can't even see the sight of food. Even your favorite dish at that point of time, you'll be like, I can't even think of eating this right now. And this happens with everyone, right? Imagine after you pura Tuesday, if you've eaten and somebody puts a buffet of your favorite food, you will not imagine that, you can eat this again, you know, and and you actually know that, in 12 hours, I'm going to be hungry again. But at that point of time, you cannot imagine thinking of food. The same thing happens, if you go to a supermarket hungry. I don't advise that you do, but if you do, you will end up overbuying, because at that time you will feel that, this much food is not enough. And the third one, this is a very interesting one. Whenever there's a terrorist attack at a particular place, you will see the security at that place after that is beefed up. Okay. Whereas that place is one of the safest at that point of time, because the same terror attack is not likely to happen there again, right? It can happen in a separate place, but you will see that after a terror attack, that place, the security is beefed up. Why? Because you cannot imagine that that place can be safe again. And that is because you are colored by the recency effect. And this is a very, very stark bias. This makes such a big impact on us that we may or may not realize, right? Like that this will happen. And so, tendency to look into the future when the present situation is averse or is very good. Like if markets are very good at this point of time, and somebody comes and says that, I probably look at, the Nifty being at like, I don't know, half of this at, any time in future. So people will think that, this guy's lost his mind, because you cannot imagine, and you don't want to imagine that as a situation. So, the emotional time travel isn't our species forte. So this is what, human beings in general are, as in the sense of, having a very, very strong bias towards what has just happened. So this, so what actually this does is, that in times of optimism, you're blindfolded to risk. And, when in terms of downturn, when you're supposed to invest, you will not invest, and in terms of extreme euphoria, when you are supposed to actually exit, you will not do that. You will do the exact opposite. That's why it's said now that investing is supposed to be easy, because you at the end of the day have to buy high and sell low, but why it doesn't happen is because you cannot imagine that at that point of time. So that's now then the other one, which is very important. So there are a lot of biases. I've just tried to cover very common ones and ones which I feel is very relevant in today's time. So the other one is called anchoring. So anchoring is basically, when you get fixated on a particular number or a particular figure, you end up being anchored to that. So if you're saying that, monthly subscription, so this is a Zoom subscription number, okay? So which one looks more attractive to you, a monthly of $15 or monthly of $12.49, and you're saving $30. So you get anchored to what you're saving, and because you get anchored to something, so that happens with stocks also, right? You look at a stock which is at 2,000, somebody tells you to buy it, and you probably forget about it. A few days later, it's at 2,200. And you'll be like, yeah, I looked at this at 2,000. A few days later, it's 2,500. And somebody still tells you to buy it. So what is important is that, can that 2,000 stock go to 5,000? But what you end up focusing on is that I looked at it at 2,000 and now it is 2,500. And that's where you get, hooked onto. The number of 2,000 is arbitrary, right? He could have told you at 1,800, but you looked at the stock first time at 2,000, and you get so fixated on that 2,000 number that you lose out on the largest story that, it could be 5,000. It could go up to 5,000, and you'll be like, "Nee, 2,000, I've seen it, it's at 2,500, and you could end up losing an opportunity at that point of time. So this is a very, very stark familiarity or an anchoring. So you get fixated on a particular number. Like, look at this one.
Yeah,
Okay.
I think the example which you have given, I think everyone which is listening to us will agree with it. Even I will agree with it. It used to happen with me. It still happens, but of course, I've tried to come out of it. I see the upside more. But I request everyone to write in the chat box whether you agree, because this example is a very common example which happens with everyone. Like today, if someone tells you about a stock and it becomes 100 rupees higher, and if I tell you it has 3,000 rupees potential, everyone will not buy because they have seen the price 100 rupees lower, right? I think that's an amazing sharing. I think everyone is agreeing to it. Happened with me in Doctor. Okay, great. So everyone is sharing their experiences.
It happened with us in March, right? When the markets were at all-time lows and there was COVID. How many people actually went ahead and bought it, right? At that point of time, how many people actually thought that, "Nay, this market is, is grossly, undervalued." At that time, everybody felt that, it's the end of the world, and nothing is ever going to look better. I mean, I still think that economy is far away from recovery and markets are at a completely different orbit. But that apart, I mean, how many people could at that point of time buy it, right? When the risk. So that's actually a combination of your anchoring plus your recency bias plus uncertainty. So all of them, and it's not necessarily one bias which will play at a particular time. It could be a combination of a lot of these which could actually end up playing, and you will feel that, "Nay, I don't want to take this decision." Again, this same thing, and this also, that which one are you more likely to buy, right? And this is what e-commerce does to you, right? You show something at a 38% discount and you show something at a 10% discount, right? And you automatically have a tendency to go to the 38% discount because it's a bigger discount. So if it is, and these won't be shown to you next to each other, but if there are two different brochures that you're looking at, one is on Amazon, one is on Myntra, and you look at the 38% discount and you look at a 10% discount, you'll end up buying the 38% because you get anchored to the discount in this case. So this of course happens in all these situations, right? In fact, this happens with broking also, right? Discount broking jo hota hai is basically this, right? That you get this much of discount, and you get a 10% discount, or you get a huge discount, or you're trading in equities, cash markets is free. And that's what happens, right? I mean, you get anchored to that so much more than you miss sight of the larger picture. And that's what happens. You tend to underreact to new information. And what happens is that you rely on a single price point or a single price that you get so matlab, fixated on that. And this happens many times, that you've missed out on a stock because you've not bought it at that price. You'll end up only due to you got fixated on that. And it plays out also when you have a tendency to be comfortable with the known rather than the unknown. Even if the latter is better. So companies that you are familiar with, right? Like you have invested in IT and you've made money in the past. Even if you feel today that say specialty chemicals is the stock sector of the future, you will still have a tendency to bet on IT because you're more comfortable with it. You're anchored to the fact that so you'll underreact to new information on other spaces. You'll tend to stick to what you are familiar with. Not that it's necessarily a bad thing. Circle of competence is always a good thing, but I'm saying that you can't be blindly anchored to something because you're familiar to it, or because it is out of just purely out of comfort that you're making that decision. So that was just really my 2 cents on anchoring. There's a very deep rooted bias that everyone faces, let me tell you. And yeah, this today's day and age, noise and information is where there is a total overload of information in today's space. So this is a very interesting survey. So I'm just giving you statistics of activities which are done, because talking about it doesn't really help as long as you have data to back it up, right? So a very simple one. In a study, participants were asked to choose between 4 different cars. Okay, the car A had the most positive attributes, car D had the least positive attributes. Okay, and first they were given 4 key things which are like make or break, like in terms of a car, like mileage, your cost, your your return on investment, your guarantee in terms of spare parts, all of that. And the second time they were given those 4 attributes as well as 8 other attributes which were not so relevant in making a decision. And so basically in the second case there was relevant data plus a lot of irrelevant data. In first case there was only relevant data, and participants were asked to choose what will you choose. With 4 attributes, 60% of the people chose A, as in they chose the correct car. They chose the correct car with the most positive attributes. And with 12 attributes, only 20% chose A. So what this shows is that the noise and the distraction add so much that it could, lead to such a suboptimal outcome. So the 40% of people chose another car and while, the four attributes were given to you were also there in the second case. You get so confused with what is important and what is not that, you lose sight of it. And this happens with individuals, right? A lot of times, you say, analysis paralysis by doing analysis, right? Like you keep analyzing so much that you're not able to take a decision. That's because, and not to say that analysis is not important. It has its very important place in equity analysis and equity research. But I'm saying that what is important is, important. So there's a very interesting quote that I really like, that it says that, the most important thing in life is to keep the most important thing the most important thing. Actually, it's a beautiful quote, and that's true for investing and markets as business and everything, in life. So this is and the service. I have the sources given below where it was done, but this is what it was, and then along with noise and information comes internet and social media, which is basically aag mein ghee dalne ka kaam, where you're constantly bombarded by information that you don't necessarily need, and that so information is not bad, but too much information and additional information which is not necessarily useful and which in times of social media has always sort of added to confusion and added to suboptimal decision making. And what happens is more and more information tempts you to revalidate your hypothesis or change your stance, without applying your mind. And this happens with everybody, day in and day out. If you keep listening to more and more and more information, if you listen to 10 people and 10 different views, you start questioning your own view. Not that questioning your view is bad, or is wrong. You should question it, but to question it for the relevant thing, right? That's essentially what I'm saying, in terms of noise, where less is actually more. And today's day and age, this is the most distracted and most frequently encountered bias. So that, and then lastly, I'll touch upon this thing called mental accounting. Mental accounting is essentially that I'll take an example, okay, and you guys can reply on this. So in scenario one, you're standing at the entrance of a cinema hall and you realize that you misplaced a 200 rupee ticket in the cab. Okay, would you buy one more ticket by spending another 200 rupees? And scenario two is that you're standing at the entrance of a cinema hall and you realize that the money you had for the ticket, you've lost that money. And now would you buy the ticket? So in both cases the outflow is the same, but the way it is presented is different. And in which case, so I'll reframe the question, that in which case are you more likely to spend another 200 rupees? You guys can use it on the chat. So essentially what is happening is that both situations, one may you lose, in the first situation you lose the ticket, which was for 200 rupees.
Most of them are answering number two, scenario two.
Scenario two, right?
Two of them answered one, two of five, most of them two, only two of them answered one. On Facebook also, most of people are answering two.
Yeah. Let them take a call. So mostly, the tendency is to go for the second scenario. And why that happens is because when you have a ticket, you feel that that is lost. So, you've kind of lost the right to sort of do that. But when it's about money, you feel like, it's just money. I can use another kind of money. If I have savings, or if I had money for 200 rupees for dinner or for popcorn, I could use that and spend it. But in essence, it's 200 rupees at the end of the day, which is going out, right? This way or that way. But most people are likely to do it in scenario two. Why this is important is because, you have mental buckets to things. In the first case, your bucket for movie ticket is already, you have a bucket where you have the ticket. And in the second situation, you have buckets of different buckets of money. And if one bucket you don't have money, you really want it, you can pull it out from the other bucket. So essentially it's the same thing, but you when it's presented to you in a different way, you end up doing that. So another example on this I can share with you, that if you have an expensive pair of shoes that you really want to buy, okay, what are you most likely to use to buy it? Your savings, your bonus money, or your tax refund? I think bonus in today's situation isn't really applicable given the scenario, but say savings and tax refund, say what is it that you're most likely to buy the shoe from?
Most of them will be answering number three.
Yeah, tax refund, right?
Yeah, tax refund.
Exactly.
Tax
refund.
So
why that happens is the cost of the shoe is the same, right? But when you dip into your savings, you feel like, my God, what a crime I'm making. I'm actually dipping into my savings. But the tax refund money is money that you're not accounted for, right? It's like it is in a sense an additional surplus that has come, and you would end up using that money because you feel that it's easier to use that money when you're going in dipping into your savings. You feel so. Point is what that money is essentially fungible. So how this can actually play out in markets is that you will take more aggressive bets when you get tax refund money. So you get 50,000 rupees which you're not expected as tax refund, or you get a gift from somebody. You are more likely to take riskier bets with that money because in your head that money is extra money. And when it's coming to savings, you are most likely to probably invest in fixed deposits, or mutual fund or something like that, because you believe that that is saving. But the point is essentially money is the same. Money is essentially fungible from whichever source you use it, right? So that's just how the human mind works. So, and mental accounting also has benefits. If you are actually saving for retirement, or you're saving for your children's future, then you are more disciplined with that saving than if you're saving for, say, a vacation, or you're saving for something less flimsy. So that is a upside to that also. But the point here to realize is that we have a tendency to create compartments, and we are more easy to spend from some compartments than the others. Whereas when you're investing in markets, or you're investing in something, the fundamental thing has to be, is this investment objectively worth it? It doesn't matter if you're buying from wherever your end aim is, capital appreciation and creating wealth. So it doesn't matter if it's tax saving or a bonus. If you would be reckless with a tax refund, you can also be reckless with your savings, and vice versa. Because at the end of the day, if you're putting that 50,000, then you're putting that 50,000. So it's just the way that human beings account for different things. It's like the ticket or the money. And we end up rationalizing this. We end up rationalizing by saying, "Arey, I'll if I," and when you make a bad decision, right, when you make a loss, then you try to mentally offset it by, it's okay, I made this much profit already, in this stock, or I made this much profit in this, so theek hai. You are accounting by that bucket. That okay, in this stock I've made so much money, ek bar loss ho gaya to theek hai. But it's not. It's You have to look at why you made that loss and how you can avoid it, rather than the fact that I've made profit 3 times, so one time loss is okay. So that's again how mental accounting kind of plays up. So this and yeah, lastly is herd mentality. I think market is actually a collective conscience of herd mentality, if you can say. And everybody is follows herd mentality. I mean, and everybody thinks that they're different because of overconfidence. Everybody thinks that I'm not part of the herd, but everybody essentially becomes part of the herd, right? I mean, that's why you'll have maximum people having invested at the tops, and minimum people having invested at the highs. So herd mentality again ties up with your confirmation bias, your anchoring bias, your recency bias. So look at an iPhone X, look at an IKEA store which had opened, and look at a Bitcoin. All right, all of this, okay, is stuff that you could have avoided because it might not have materially added. You could have had a OnePlus, or you could have had an MI phone, and you could have been doing just as fine. You could have had furniture which you don't necessarily need, but look at the jam that the IKEA store had caused, and look at the upside of the Bitcoin, and the same thing happened on the downside as well with the Bitcoin, right? And why that happened is essentially because everybody kept buying. It's like the greater fool theory that whoever buys at the end will be ending up facing the music, but till that time the party is on. So that is essentially herd mentality. And I'll end with this one. Actually, there's a beautiful one which actually shows literally a herd. So this is basically a herd of sheep which is leaving a stall, and actually there is no fence there. If you see, there is a gate, but on the two sides there is no gate, so they could just go out from there. But this is what exactly herd mentality is. They're all going in through the gate. They could easily go out from the side, but they're all just going in through the gate. So that this is exactly what herd mentality is. And all of us, we like it or not, end up doing this. You will be far more comfortable buying a stock that 5 people are buying than buying a stock that nobody is buying, even if you believe very strongly in that. So I mean, this is the very, very stark example, and this picture actually says it all about herd mentality. So every time that you're following the crowd, just look at this diagram. This is a very, very powerful one. I thought that I should share with everybody. And yeah, this is pretty much the end of my thing. I'll just leave you with key takeaways. So everybody has biases. I mean, it's not like a great investor will not have biases. Everybody's constantly battling those biases. The first step is acknowledging that you have a bias. Second is recognizing that you're falling prey and trying to step back and think objectively. And this is a constant process. I mean, it's a framework because this is the way that you're tuned. That's essentially why it said that it's simple but not easy. because, and everybody faces this, right? From like, I mean, I've seen some of the best investors. Everybody faces those biases. If you are, mature enough, emotionally to understand that, no, this is a bias, or is this a conviction that I have, so you can, it's very important to differentiate between what is a bias and what is a conviction. Conviction would be based on objectivity and, grounded by data, whereas bias would be based on, some past experience, some color that, you have on something. So I think extremely important to kind of differentiate between the two, and yeah. So I mean, this is pretty much the end of my thing. I think I'll end it here and open to questions or whatever that anyone has.
So I think you shared some great insights on with us, and you showed us the way how people actually get a bias. So where you can close your presentation so that we can have some Q&A, and of course I also have one or two questions to ask. So we'll go through that.
Yeah, sure. I have stopped my screen share. Is it still visible?
It's still visible.
Yeah.
Okay, perfect. So first of all, before we go to the questions, I think thank you so much for giving such a wonderful presentation. It was really amazing the way you shared it, the examples you shared, the different biases which you explained. I think this will help people a lot in their investing decisions as well as trading, and they'll try to first acknowledge, as you told, that acknowledging is very important. Even I also have biases. Everyone has biases.
Everybody has biases. Everybody.
Quickly, true, absolutely. The quickly you acknowledge it, the quickly you work on it, you'll get better on it, and of course, it will help you a lot in your invest. Trust me, like after seeing it, maybe I'll also acknowledge my biases, and I'll work on it, and definitely I'll try to reduce it next time I buy or sell a stock. So thank you so much, Prasham Bhaiya, for such a great presentation. I think everyone loved it, and it was perfectly matched with some great examples plus some great data sharing, as well as making people understand what behavioral finance is and why is it important for everyone. So before we go to questions, where would you like to recommend any book if someone wants to read, or maybe some article, or maybe something which they can refer to? Because I think this is a very important and very interesting topic, and you have explained it in a very perfect way. So if anyone want to learn this in details, would you suggest something on that?
I think on the net itself, there are enough and more, videos, talks available on behavioral biases. There's this book called Little Book of Behavioral Investing by James Mortimer. It's a very good, very powerful book. It's an old book, but you can basically look at it. It's called the Little Book of Behavioral Investing, where all of this is discussed at length on biases and how we fall prey to that. Otherwise, I mean, internet in today's day and age, Google Baba Zindabad. I mean, you can just type biases in investing and you get a lot of examples of biases.
True. So now I'm opening up to questions. I think people would have some questions on their mind. So I'll take few questions on Zoom as well as on Facebook, people who are watching us. Okay. So there's a question: why has mutual funds not grown despite jump from 33,000 level in March? So I think again that's not a related question.
But if you
So
want my view, it's completely my personal view. Is that I think that maybe that's because they were all sitting on cash and they were expecting the markets to correct, but that didn't happen. But that's entirely my view. I don't have a definite answer for that. But and it's not part of this. But I think that and most investors are also sitting on cash because people thought that they didn't see the markets to go up and run up the way it did actually, because economic reality was very different, right, from that. So I think that would be my guess, but it's just my hypothesis.
absolutely. So there's one interesting question. Is there any way you can record your biases and score them so that we can like maybe write them through the basis of scoring and in terms of quantitative analysis? Like, is there any way one can record the biases and score them? Like, is it possible?
Record the biases, I think you'll have to do it for yourself, right? Like whenever you're falling prey to something, and you feel that suddenly you're jumping, that you're not buying. I try to give a little bit of flavor here, but whenever you're falling prey by like saying not buying a stock at a particular price and getting anchored to that, or following the herd, you can probably step back and say that I mean, everybody is doing this, but do I want to do it? Like by just being intellectually honest to yourself, you know, more than anything else. You can probably record it that, you know, maybe this is a bias and maybe this is not this. And somebody that you hold in high regard, some outsider, if you discuss with them, they can give an outsider's perspective to it also. That, you know, if this is really, a bias or it's a conviction. And I think that difference is very important. Conviction is something that, you know, you should have if you've, you know, worked hard and you feel that, you know, it's based in a conviction which is based on facts, or it's based on a past experience. That, you know, I mean, like a simple example would be that, you know, you want to buy something that nobody else is buying, and, you know, or you don't want to buy something that everybody is buying, and, you know, you ask yourself why. Because I lost money in the past, is that the reason? Or do I think that this will not do well because of ABC reason? You know, that I think is a way that, you know, it can be a starting point. But I think everybody constantly battles these biases. So the first step is to acknowledge that it's there. The second step is try to be a little objective. And I think the noting down and assessment is something that you have to do yourself. I mean, that I don't think can, because everybody will have a different bias which they are, you know, prey to. So
Absolutely. So I think that depends from individual to individual, and you have to write down your biases. So there's a question of most of the experts has opinion that expensive buying is good rather than buying cheap. What's your opinion on that?
no, no, I don't know. I mean, I don't know if experts have the opinion that buying expensive is good. I don't think so. But it really depends, yeah. I mean, it depends on how you see a particular. So the reason why people want to buy expensive is because they want to play a momentum, and they feel comfortable buying it when they're playing that momentum. That, you know, it's expensive, but, you know, it's likely to get more expensive. So that is the thing. But you know, and the problem with buying cheap at times is that, you know, what is cheap for a reason, and it continues to remain cheap for that particular reason. So that is one of the reasons why, you know, people would say that buying expensive. But I think that there is no blanket rule that, you know, you should buy expensive or you should buy cheap. Like that I don't think is true. Most investors, so you will have value and you will have growth, and you will have somewhere a middle of media, you know, a midway between the two. So I don't believe that there is a one size fits all. It totally would depend on what stock, what sector you're looking at. And a lot of money is actually made in contra calls, you know. And by contra call, I would mean that, you know, uh, in the lows of the 2007 8, or in the lows of, you know, when nobody is looking at a sector or a stock, and, you know, you have a lot of conviction and bias, you know, belief, not a bias but a conviction that, you know, a sector is likely to do well, and you hold on to it through the, you know, ups and downs, is where a lot more money is made. But having said that, everybody has their own different style, and I personally feel that there is no one size which fits all. So
Absolutely great. I think that was a perfect answer. That everyone can has different types of views and they make money. It may be contra trading or maybe buying cheap or buying expensive, but it depends from individual to individual. Because as you told that something is cheap, it has to have a reason. So that is of course which is very very important. So the next question is how to manage if the market is overvalued and we see our stock prices which is very high during bull market. I mean, when to sell and considering the behavior, when to sell during the bull market. So that's the question.
when to sell would be when, you know, everybody else is buying. Actually, that's really the short answer to a long question. But and when to buy is when everybody's selling. But, you know, that is where, you know, it particularly is where we go wrong. But, you know, so there is anecdotally, just being on a lighter note, you know, there's a saying that, you know, when your watchman says that, you know, stock markets mein paisa ban raha hai, is the time that you should be selling your stocks and sitting on cash. And, you know, and when, you know, your most gung-ho friend in capital market says that, you know, markets are horrible at this point of time, is when you should probably start investing, you know. And that is generally the thing. But yeah, during a bull phase it's difficult to say, and it's very bad because you could, you know, say exit at a level, and you could see stocks going 10, 20, 30% higher from there, and then you could feel like, you know, Array, what did I do? But I think the entire game of investing is actually based in, you know, being, you know, aware of the risk, and being, you know, more conscious of, you know, the downside than the upside. The whole game is actually of, you know, being pessimistic and not being optimistic, in that sense. If to say, not that you be pessimistic all the time, but the you know, always be erring on the side of caution. So I mean, it's important to, I mean, that is basically that, it's okay if, you're, not exactly right. Like, you can't see, nobody generally, very few people, I mean, are able to buy at the absolute lows and sell at the absolute highs. That actually just doesn't happen. That's really a myth. But if you're able to buy somewhere near the low and sell somewhere close to the high, it's okay. I mean, you could have bought it 10-20% above the lows, and you could have sold it 10-20% below the real highs. But if you're able to do it somewhere there, then that's kind of okay. That's my point. I mean, and that's a stock specific thing, because bull market and bear market is all in hindsight, right? So it's only in hindsight that you realize that this, how much this is going to fall. So, or you have good stocks where you have particular targets which you feel are based on particular things, and you stick to your target. I mean, today if I want to buy something at X and I want to sell it at say 41.4X, I should be happy to do that. And I don't care if that 1.4 goes to 1.8, but I am sure that I don't want to sell it at 0.8. I don't want to sell it. So I mean, I don't have to be precisely right, and very few people are precisely right. But you don't have to be exactly wrong, right? You can't buy something and then it falls 80% on your face, and then you're holding on to it. Then that's being precisely wrong. So ideally, don't try to time it. I mean, there's a big thing on timing markets and how difficult it is. A lot of very smart people are not able to time the market. So I mean, I don't think that I'm smarter than the smartest people. But the point is, the beauty of markets is that you don't have to be. You just have to be ballpark right. So that's essentially it.
I think where the thing about timing which you told, there's a very particular quote which I remember, that timing the market is not important. The time in the market is very important. And the example of watchman which you gave, I think that is a perfect one for defining a bull and bear market. I'll take last two questions, because of course it's a Sunday night, and I don't want, already people are would be waiting for watching IPL and spending time with the family. So I don't want to take them much time. So last two questions, I think there's an interesting question. Is it okay if we go with the flow, because all will buy one that share which will go up, like for example Reliance, or maybe should we go with that, or should we go with the flow, or should we think something which is different, as you told?
So you can think something which is different again, but you have to again just make sure that why you're thinking something which is different. Do you have a reason for it? Do you have an objective reason for it, or it is based on something you heard somewhere or someone told you, or what it is? Like, the thing with being different, there's nothing wrong, and a lot of money can be made that way. But it's just that you have to be honest to yourself that why you're being different and why are you going with the flow. Right? Like, so like he said, the example of Reliance, upar ja raha, to upar ja raha, right? So I mean, see, again, there is no one size fits all. Reliance is going up for a different reason, and HUL is going up for a different reason, right? I mean, and which one do you think is likely to sustain? That becomes the question, there. But that's essentially it. So there is actually no right or wrong in that. I can only tell you that if you're buying Reliance and you have very strong reason to buy Reliance, you feel that from here, you feel that the game of telephone and IT and all of that is still to play out, then it doesn't matter if you buy it here, right? Or you buy it here, or you buy it 10% upward. But if you feel that that has played out, and that's where it depends on what you feel. So you can base your views on reports, you can base your views on news, etc. But that's where it depends. And if you feel that something completely out of the blue is something which is going to do well, you need to have a reason to know why you're doing that, right? I mean, you have to have a reason. That itself is the biggest thing. That unless you have a reason, it is just based on something you heard and something you said, and somebody told you and somebody thought so, and all of that. So that is essentially it.
I think perfectly answered. So one, because most of the questions which I'm finding rest is stock specific and not related to the topic maybe. So one last question there, which I asked to everyone, which is the topic which is there for us, that is market kya lagta hai. That is the thing which everyone wants to know. So that is the headline. So please, some few insights on that before we close down the webinar today.
Honestly, I mean, markets are like the Indian cricket team, that everybody has an opinion on them, but it's only the, so it's absolutely that. But I think that if you ask me fundamentally, I think that markets have run up a lot. and we're still coping with the crisis, and the markets don't really have factored in a lot more in the future. And I think that there could be, it's a time probably that you could be cautious. But having said that, there are some very interesting opportunities, especially in the mid caps, etc., that I think are there. But purely this is my view. I think that I would be a little more on the side of caution at this time. Personally, yeah. I mean, having said that, it can go up tomorrow, it can go up day after. I mean, I don't know, but I personally, I am a little cautious.
Absolutely. I too have the same view that you should be a little cautious. Of course, maybe diversify your asset classes at the present moment because the market has already run up and is already discounting the future good events which are going to happen, as
Yeah,
we know the market is forward looking. So once
yeah.
again, thank you so much, Prasham Bhaiya, for such a great webinar. I think everyone enjoyed it a lot, and it was great learning. Even I also learned a lot, and even I think the audience also learned it, and in a very very simple way with some great examples. You have explained what is behavioral finance and how it affects our life as well as our investing and trading decisions. So before we close down, some closing words from you would be appreciated. Where we should like closing words, as in some appreciation or maybe some something which you want the people to go through from here and go learn from in terms of behavioral finance.
No, I just think that everybody should know that, I mean, the only key takeaway is that, uh, nobody is perfect, first and foremost. Everybody ends up thinking in various ways emotionally when it comes to markets or finance in general. And just the first thing is that, to acknowledge that you end up doing that rather than be defensive that, no, I am the most rational with it. And everybody is like that. The differences between the people who are successful and who aren't are that, they try and look inwards and see where they are going wrong rather than, see point fingers at where everybody else is going wrong. And that essentially is where, I mean, that's the only thing that this topic can say, that, it probably, if like, if somebody else is making money and you're not, then is that person is doing something right. And the softer aspect is that of temperament more than skill. So I mean, always look at, what you're trying to do, and be honest that, don't be close to the opportunity, to the option that, this is something that you could be wrong on. And just that's about it, that, and obviously keep growing, keep investing, happy investing, all of that. But always acknowledge that this is a possibility, that, I am not the most rational when it comes to decision making, but I can at least work on being so. I think that can be it. I mean, I can acknowledge that I am not, and I can see what I can do best to, and everybody constantly battles these biases. It's nothing which is, uncommon or anything like that. So I mean, it's just that.
Absolutely. Some great words of wisdom by Prashmya, where he has already told that we have to keep learning constantly. You have to keep recognizing your biases and work on them and improve them. And one day, definitely, no one is perfect, but you can try to become perfect in terms of your biases. And if you do it, it will help you tremendously in your investing and trading decisions. I think this we have learned already. And once again, thank you so much, Prashambya, for taking out your precious time and
Thank you.
sharing some great insights
Thank you
for,
so
for our
much.
audience. I think everyone benefited a lot. We are getting some great feedbacks on Zoom as well as on Facebook. So thank you so much, everyone, for joining us, for sharing your blessings, for sharing your insights, for sharing your love with us. Keep sharing these
Thank you.
blessings and this love, because we this motivates us to do well and to call speakers like Prasham Bhaiya, who share some great insights, some great wisdom, some great knowledge on market in such a simple way and without any biases. I think that is the most important thing.
Yeah.
So great learning today. And once again, we'll meet you next Sunday with some great learning again with a great speaker. And trust me, next Sunday we have another speaker who will be speaking on a wonderful topic. And he's a very well-known speaker again. So thank you so much, everyone, for joining. Keep sharing your love, keep sharing your blessings, and thank you so much for your response for our YouTube channel as well. We have started uploading these videos on our YouTube channel, and of course, you have shown some great love. So we'll upload this video also in sometime soon, and I hope you are enjoying this and you are enjoying our technical series as well, where we are making lots of videos on technical analysis, so that You don't have to depend on anyone else for investing and trading decisions. So till then, believe in yourself, have confidence, do not have biases in your life as well as investing, and stay safe, stay at home. Good night, everyone. I'll see you all once again next Sunday. Till then, keep enjoying, keep learning, keep sharing, and keep joining our knowledge groups so that you keep getting the market updates and the market commentary regularly, which we share on WhatsApp. So once again, good night, everyone. Stay safe,
Thank
stay
you.
home.
Thanks, everyone. Bye.
Happy
My
weekend
pleasure.
ahead and
Bye.
happy trading week ahead. Bye bye. Have a nice week ahead. See you all next week.
Bye.
Good night.